Welcome to Breaking News to Trading Moves.
Good to be here.
Today we are looking squarely at the medical technology sector. We have to talk about the latest quarterly report from Medtronic.
Ticker MDT.
Right, MDT. And it's really the headline of the day for medtech, and it's just such a classic case of good news, mixed with some real market anxiety.
It really is. You look at the report itself, operationally, the company's doing what it's supposed to,
But then you look at the stock chart.
and it tells a completely different story.
Exactly. If you just saw the top-line number, you'd think it was great news. Medtronic beat profit expectations. They made more money than analysts thought they would.
They certainly did.
And there's always a but. The stock price slipped. It didn't go up, it went down. So how does a company beat the numbers but lose value?
It happens more than you'd think. It almost always comes down to what the company says about the future.
Not the past 3 months.
No, the market is a forward-looking machine.
Okay, so here's our plan. We're going to look at the Medtronic headline, why they beat, and why the market still wasn't happy. Then we'll break it down into the winners.
The companies that actually look pretty good because of this data.
And then we'll balance that with the losers, the areas facing some pressure.
Sounds like a plan.
Right, let's start with that headline. Medtronic, MDT. They exceeded quarterly profit expectations. What went right? I mean, they're obviously selling something people need.
It really boils down to demand, just strong demand for their cardiovascular devices. The report specifically called out cardiac ablation and PFA.
PFA. Let's pause there. That's pulsed field ablation. We should probably explain what that is for anyone who, isn't a heart surgeon.
Right. It's a critical new technology. Traditionally, to treat atrial fibrillation or AFib, doctors used heat or cold to destroy the tissue, causing the irregular heartbeat.
Thermal energy.
Exactly. PFA uses electric fields instead. It's generally faster and safer for the surrounding tissue. It's a real step up.
So it's a better mousetrap.
It is. And hospitals are adopting it. The uptake was solid. And more broadly, procedure volumes were solid. People are going to the hospital. They're getting these surgeries done.
That feels like a key point. For a while, the big worry was staffing or people just putting off elective procedures, but this says the core business is working.
At its core, yes, the business is performing, but the market reacted badly because of the guidance.
Ah, the dreaded guidance. This is where the story turns.
Medtronic kept its full-year earnings per share guidance unchanged. They didn't raise it.
So they made extra profit this quarter, but then told investors, don't expect the full year to be any better than we originally thought.
Precisely, which implies that maybe the back half of the year is going to be a little tougher, or at least more expensive. And they gave some reasons.
Let me guess. Taxes and tariffs.
You got it. Management flagged headwinds from taxes and tariffs.
We're hearing that a lot on earnings calls these days. It seems like every CFO has to have a section on trade policy.
They do. And for a company with a global footprint like Medtronic, saying you see costs coming from tariffs, that makes investors nervous.
Because it suggests all that extra profit from strong demand might just get eaten up by higher costs later on.
And that's the whole market psychology right now. We're in what you might call a bar-raising market.
Meaning good just isn't good enough anymore.
Exactly. Strong demand is just the baseline. It's the price of admission. If you want your stock to go up, you have to beat the numbers and tell Wall Street the future looks even better.
And Medtronic basically said, the present is good, but the future has some bills to pay.
And for that, the market punished them.
Okay, so that's the setup for Medtronic itself. But now let's talk about the rest of the board. Let's get to the winners. Because if procedure volumes are strong, other companies have to be benefiting.
Absolutely.
Even with Medtronic stock slipping, the data in their report is actually really good news for some other players. Let's start with category 1, cardiac ablation and electrophysiology.
This makes perfect sense. If Medtronic is selling a lot of these new ablation tools, it proves the market is there. It signals a healthy upgrade cycle.
So hospitals are actively buying the new tech. They're upgrading their tools for treating AFib.
Exactly. It confirms the demand is real and growing. It isn't just a Medtronic story. The entire market is hungry for this technology. So if you're another company in that space, this report is a very positive signal for you.
Okay, so who are the specific tickers?
You have to start with Boston Scientific. Ticker BSX. They're a direct peer with a lot of exposure to cardiac devices. They have our own PFA system.
So if the market is hot for Medtronic's devices, it's probably hot for theirs too.
Right. It validates the whole category. And
Yeah.
the other big one is Abbott, ticker ABT. They're another major player in AFib treatment tools. The Medtronic data just confirms their playing field is fertile.
So Medtronic takes a hit on its guidance, but Boston Scientific and Abbott get a thumbs up on demand.
In a way, yes. They get the benefit of the macro data without having the same specific guidance issue, at least not in the market size right now.
All right, let's move to the second category of winners. Broad procedure volume, medtech. This goes back to your point about people just, going to the hospital again.
It connects right back to that. When hospitals are doing more surgeries, it's not just the fancy new ablation device they need. They need more of everything.
The clamps, the surgical tools, the robots.
The whole supply chain gets a lift. Robust procedure volumes mean higher utilization of everything in the operating room.
So who wins when that happens?
Stryker is a big one, ticker SYK. They are huge in surgical tools, implants, all the fundamental stuff you need to do a surgery. If operating rooms are busy, Stryker is moving product.
And I'm guessing the robotics companies fit in here too.
They absolutely do. Intuitive Surgical, ticker ISRG.
The makers of the Da Vinci robot.
Right. And with Intuitive, sure, they make money selling the robot. But the real money is in the instruments and accessories used during each surgery. It's a recurring revenue model.
The classic razor and blades model.
You got it. So high procedure volume means those expensive robots are being used more often, which means more revenue from those high-margin accessories. Medtronic saying volumes are solid is music to their ears.
Okay, category 3 of the winners. We've talked about the device makers. What about the places where the work gets done? Hospitals and providers.
It's the logical next step. If procedure volumes are sticking, if they're staying high, then the providers see better operating room utilization.
And an empty OR is an expensive OR.
Extremely. Hospitals have huge fixed costs. When you can fill those rooms, especially with higher margin elective procedures like cardiac ablation, it dramatically improves the financials. It improves the mix and supports revenue per bed.
So which hospital chains are we talking about here?
HCA Healthcare is the big one, ticker H-CA. They have the scale to really see the benefit of this trend.
And what about Tenet?
Yes. Tenet Healthcare as well, ticker THAC. Both of them win when people feel confident enough to schedule those procedures. Medtronic's report suggests that's exactly what's happening.
So to sum up the good news, the underlying patient demand looks pretty solid across the board.
The fundamentals of the market are good. The patients are there.
Okay, but we have to talk about the flip side. Let's move to the losers. Who is feeling the pressure from this report?
Right. The first category here is really about sentiment. It's the beat but flat guide risk.
And this goes right back to what hurt Medtronic itself.
It does. The investor mindset is it's unforgiving right now. When you beat estimates but don't raise your full-year outlook, the market sees it as a warning sign.
It implies the company's worried about something coming down the pike.
Or at least that cost pressures are going to absorb all that upside. So obviously, Medtronic, MDT, is the primary example here. But it casts a shadow on others.
Who else gets dragged down by that?
You look at other large-cap medtech names, think Johnson & Johnson, ticker J&J.
And Baxter.
Baxter International, BAX. Investors might look at the Medtronic news and think, well, if Medtronic can't raise guidance with strong demand, maybe J&J and Baxter can't either.
It's caution by association.
Exactly. It resets expectations for that whole group of what you might call reliable, steady companies.
Okay, second category losers. This one is more specific. The acute monitoring competitive shakeup.
This was a smaller detail, but it matters. Medtronic's monitoring business is facing more competition.
And there was a specific deal that caused this, right?
Yes. Danaher, ticker DHR, acquired Masimo, ticker MASI.
So Danaher buys Masimo, and the whole competitive landscape in that niche changes.
It creates a lot of uncertainty. When a huge player like Danaher makes a move, it threatens pricing power, it threatens market share for everybody else. It just raises questions about margins for that entire business line.
So Danaher and Masimo, DHR and MASI, are facing a kind of show-me period from investors.
Exactly. It's a battle for market share, and battles are expensive. Medtronic feeling the heat there confirms the fight is on.
All right, third and final loser category. This is the big macro one. Tariff and supply chain cost exposure.
This is what spooked the market most in Medtronic's guidance. Management was explicit. Tariff-related costs are a future headwind.
And Medtronic is hardly the only company with a global supply chain.
Far from it. This affects pretty much any large company that makes physical things. If Medtronic is flagging this, investors immediately start looking for who else has similar exposure.
They start pricing in higher costs for the whole group.
That's right. They assume that if it's going to be a problem for Medtronic, it's probably going to be a problem for others too.
So which tickers get caught in that net?
Becton Dickinson and Company, ticker BDX. They have a massive global footprint. They make billions of basic medical supplies. If tariffs are a factor, their costs are likely rising.
And Edwards Lifesciences?
Edwards Lifesciences, EW, same logic. The whole sector can see what's called multiple compression.
Can you break that term down for us? Multiple compression.
It just means investors aren't willing to pay as high a price for each dollar of a company's earnings. If there's more risk, like tariff risk, they might only pay, say, 18 times earnings instead of 22 times earnings.
So the stock price can go down even if the company's profit stays exactly the same.
Exactly. The value investors place on those earnings drops, and that's the risk for BDX and EW Medtronic just rang the alarm bell on tariffs for the whole group.
So let's bring it all together. We've got a beat on profits, strong demand, busy hospitals. That's the good news.
But then you have flat guidance, worries about taxes and tariffs and competitive pressure. That's the heavy stuff.
It's a real tug of war. The business is performing, but the environment is getting tougher.
The trader's takeaway here is pretty clear. The fundamentals, the actual demand, it's there. But right now, guidance and costs seem to matter more to investors.
They're focused on next year's bottom line, not just last quarter's revenue.
That's the long and short of it.
So the final question. We saw the diff in Medtronic. Is this a one-off event or something more?
The question to ask is this. Will the market treat this as a one-day de-risking event, where they just flush out the nervous investors and move on? Or is this the start of a broader guidance reset for large-cap medtech? Are we entering a period where any company that signals cost uncertainty is going to get punished no matter how well they're actually operating?
That is the million-dollar question. If it's a one-day thing, some of those winners we talked about might be on sale. If it's a reset, there could be more pain ahead.
And that's what makes this market so challenging. You have to decide if you trust the procedure volume data or fear the tariff warnings more.
Well, that is all the time we have for this look at the Medtronic report and its effects across the sector.
It's a complex picture, for sure.
Before we sign off, I need to read our disclaimer. Please note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thanks for listening to Breaking News to Trading Moves. We'll catch you on the next one.
Take care.